There is a wide array of investor classes that are abound in the financial markets. Where some are looking to park their life savings in appropriate investment facilities, others are looking to gradually build up a fortune by the time they retire. Certain market participants are looking to enter moderate positions in attractive securities, not worth more than $500, which could take off by significant proportions in the short to medium-term future. In this video, we cater precisely to the investor of this mindset. With all the uncertainty clouding financial markets with the disruptions of this year, there is little clarity about where the small investor could park a sum of $500, which would result in maximized returns. The stocks covered in this video are essentially no-brainers, in the sense that their upward climb is all but guaranteed to take place in the coming months and years. We start off our list with the world's leading and most innovative travel company, Airbnb Incorporated, trading under the ticker ABNB. The company's revolutionary business model has disrupted global travel dynamics, putting it in a highly sustainable position. It has, over the years, set itself up such that it has limitless inventory in over 200 countries, whilst holding no direct ownership of a single hotel or apartment. Airbnb is such a compelling buy, primarily due to its massive undervaluation. The stock traded at $173 at the start of the year, and is now down to $97. This decline comes despite a terrific Q3 performance recently reported. The company beat analyst expectations by almost $36 million and delivered $2.88 billion in revenue, which was a full 30% higher than the prior year's figure. Total bookings stood at almost $100 million, reflecting a 25% increase from 2021. Net income jumped from $800 million to $1.2 billion. With Airbnb's 42% income margin, the company stands as a value-creating machine, too good to ignore. Its cash and equivalents stand at almost $10 billion, making it highly capable of withstanding the macroeconomic storms. Even at such a mammoth scale, Airbnb is rocking such impressive growth figures, due to its strong brand marketing, which is highly attractive from an investor's standpoint. The company is also launching new features such as air cover, and techniques to ensure last-minute cancellation is minimized. It is seeking further expansion to cater to the rapidly growing hybrid worker and digital nomad markets. Airbnb has also massively restructured its organization to make the company leaner, and better able to withstand recessionary pressures. Airbnb is one of the best stocks in the market and therefore, is a no-brainer for any investor. The second stock on our list is one of the finest insurance companies in the world, Sun Life Financial, which trades by the ticker SLF. Sun Life, despite its excellent fundamentals, growth prospects, and high-quality business model, is perhaps one of the most underappreciated names in the insurance game. For one, it's a Canadian company, making it a great way to add geographic diversification to one's portfolio, off the bat. Secondly, it has an excellent track record, given its business optimization, since it was established back in 1865, surviving through some of the most disruptive shocks the world has seen in almost 160 years. In fact, since 2000, Sun Life has outperformed all of its peers, the wider market, and even Nasdaq itself. The company's compound annual growth rate stands at 8.1%, whereas the financial sector annually rose by 2.3%, Nasdaq by 3.3%, and the S&P 500 by 4.2%. In fact, Sun Life is not only bright in terms of its track record, but also considering its future outlook. Analyst consensus places the company's income growth expectation at 12.5% per year, compared to the S&P 500's 5.8%. This is because the S&P 500 is dominated by companies that prefer share buybacks over dividends. The company, with a 60% profit margin, and 12% EPS growth is extremely attractive. It presently stands as one of the most reasonable investments on Wall Street, which is why it is such a compelling buy. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. For number 3 on our list, we take a look at a notable player from the refrigeration industry, Hudson Technologies, which trades under the ticker HDSN. In the last 12 months, HDSN climbed from $3.60 to $10.20 in its price, owing to its spectacular financial performance. In its most recent quarter, Hudson saw its revenue climb from $60 million to almost $90 million year over year, whereas its net income almost doubled from $15 million to $29.5 million. The primary reason Hudson is a no-brainer is due to political reasons that are creating an artificial shortage to drastically inflate prices. Politicians across the world have been clamping down on the production of hydrofluorocarbons, better known as HFCs, citing environmental concerns. In the US, there is rare consensus with both Democrats and Republicans regarding this issue, after the passing of the AIM Act, to enforce an 85% production cut down. The result is a drastic surge in refrigerant prices which Hudson, as the market leader in the game, could tremendously benefit from. The refrigerant market is a global one, and one that is unlikely to see a dent before the next decade, given no viable alternatives as of yet. Even though the stock has almost tripled in price over the last year, it still stands heavily undervalued given its future prospects. 2022 revenue is expected to grow from $193 million to $315 million, whereas EPS is set to climb from 69 cents to $2.17. Management has indicated its intentions of using excess cash to pay down its debt and engage in acquisitions. The stock is a buy for all the right reasons. The 4th stock on our list is the small, but the very promising pharmaceutical company, Assertio Holdings Incorporated, which trades by the ticker ASRT. Being a pharma stock with a market cap of less than $200 million, one would expect the market to lay off ASRT as a risky play in the present macroeconomic circumstances. Despite this, however, the stock has risen from $1.14 to $2.65 in the last 12 months, where the S&P 500 had seen a significant drop. In terms of revenue, the company delivered top-line growth of almost 10%, despite being in an early development phase. Moreover, the company reported a quarterly EPS figure of 16 cents, which was double the amount of earnings analysts had expected it to deliver. This positive performance is driven primarily by its flagship product, Indocin, an oral solution that is widely prescribed as the treatment for rheumatoid arthritis. What is quite remarkable is that the management had a stroke of brilliance in the recent quarter, when it negotiated the terms of senior convertible notes, which have resulted in savings of over $4.5 million annually in payments. There's tremendous opportunity inherent to Assertio Holdings. It offers consistent profitability with its existing product line, as well as a major upside that it anticipates realizing in the coming years, with positive milestone updates for its other treatment candidates. This micro-cap player has all the aspects of a stock that is equipped to take off on a rocketing growth trajectory. The final stock that we end our list on is that of Lumen Technologies, which trades by the ticker LUMN. Lumen operates in the communication services business and has been one of the more controversial names among investors, given its performance in the prior years. Revenue has been in a constant decline since 2018, and its stock has fallen by almost 55% since the start of the year. The bulk of this price drop comes after the release of Lumen's Q3 results, where it had severely missed its earnings target of 35 cents. The company had delivered a mere 14 cents, in comparison to the prior year's 49 cents. The mass sell-off that has incurred, however, has brought LUMN down to dirt cheap levels, which does not stand justified in the wake of wider realities. For one, the company has been explicit that it is in a restructuring phase, towards a leaner business model after selling off its assets in Latin America. Its cash position is also extremely strong, having wiped off $16 billion of debt in the last 5 years. Its current assets exceed $9 billion, which makes it capable of executing its renewed business strategy. Although the company has decided to ditch dividend payments, it is set to authorize a share buyback program, which could see share float being cut down by almost 25%. In light of this holistic view into Lumen, its price plummet is bound for tremendous upside potential in the coming months, and anyone that loads up on this stock now could see a surge in their capital amount. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for long-term growth. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.